Okay. Now let's try to understand about securitization through a real world example. So securitization of accounts receivable, let's try to understand that through American Express as a company. So basically what happens, American Express is a company, or I can say bank or investment banking related business, wherein they have transferred $1 million worth of credit card receivable to a special trust. So $1 million credit card is like people need to pay $1 million to this American Express, and American Express transfers this to a special purpose trust. Now what happens, that trust goes and issues securities backed by these receivables to investors. So if you want to understand it, you can understand it through this scenario, wherein this is Amex, American Express, and they are going to receive $1 million. Now people don't pay 1 million, they may pay 900,000, 800,000, 950,000, or even 1 million, but there are some chances of bad debts as well. So Amex go and create another company, and they call it as SPV, special purpose vehicle, or they call it as a trust. Now within that trust, what happens, this $1 million is sitting. Now what happens, there are a lot of people who believe that okay, we can pay money against these accounts receivable, because there are investors who think that if uh, we pay the money against these receivables, the value of them may increase. For example, Amex has issued, let's suppose, securities, and these securities are worth $10 each. Okay, so all the investor go and buy these securities, I can say shares or securities. So what happens, this entire money from these investors reaches to whom? This money reaches to special purpose vehicle, and from this special purpose vehicle the company can use that money. And right now that money is sitting with whom? The people who have taken the credit card and they haven't paid as of now. So people have not paid whatever credit they have taken from Amex, they will be paying, and these credits may be due to the credit card, whatever reason they are using. So they have not paid to Amex, they will be paying in future. Amex needs the money as of now, they create a special purpose vehicle trust, and that trust needs the money, so they go to investors and sells them these securities was $10, $100, whatever is the price. The investor pay the money to SPV, and SPV gives that money to Amex, and Amex can use the money even without customers paying the credit bill as of now. So this entire process is known as securitization process. Now for this entire securitization process, you can see further that trust issues securities backed by these receivables. These trust issue the securities. As card holders makes payment, cash flows are being used to pay the investors their principal and interest. So when the credit cards the payments are being done, then the investors are being paid also if needed. Not always the investors are paid, because if these securities are selling within the secondary market, what I mean by secondary market, if they are listed on a stock exchange, they can sell and buy each other as well. So what are the components within the securitization? So the first component is receivable transferred is $1 million. Who is the entity who is receiving the receivables? Then there is a special purpose trust. I told you, special purpose vehicle or trust, and these securities are issued by the special purpose vehicle, but the collateral is what? The collateral is accounts receivable, because they will be paying the money. So these kind of financial instruments are existing within the market. And finally the investors are the people who receive the cash flow as receivables are collected. As then when the company receives the money, these are transferred to the investors. If the securities are listed on the stock market, then not essentially always those are transferred to the investors. They can sell and purchase the securities among themselves. Now the key point here is securitization allows the company to convert receivables into immediate cash. They can convert these into immediate cash as well. This is one of the method. Investors assume the collection risk of underlying receivables. If debtors don't pay entire money, then investor have this risk. For example, this was $1 million. Now let's suppose instead of 1 million, debtors pay only $900,000. So what happens? If every investor has paid $10, now their $10 share price become $9 because there is a loss of $100,000 here. You can see a loss of $100,000. So that loss is being borne by whom? That loss belongs to what we call as investors. So investors assume the collection risk of underlying receivable. And finally, common in credit, mortgage and auto loan industries. This is very common in loan industries when you will go and study, and after that you will do your job. You will see the companies use this very frequently, but primarily the loan industries use this. Now, let's understand the securitization through a textbook concept. So textbook concept is simple, that securitization is the process in which company transfers accounts receivable to another entity such as a trust or subsidiary. They transfer it, and then receiving entity, meaning this trust or subsidiary, issues the securities backed by these receivables to investors. So these securities are issued to investors. The mechanism is like investors purchase these securities and receive cash flow as the underlying accounts receivable are collected. When the credit card people holders pay to the credit card company MX, then these investors start to receive their cash flow. This allows the company to convert receivable into immediate cash. The company gets immediate cash while transferring the collection risk to investors. Now that transfer to investor. The common use is like this is frequently used in the credit card industry, mortgage industry and auto loan industries as we discussed above.